China has an eye on the Indian market, we know that. It wants to invest in Indian companies. It wants to earn from the Indian consumer. But China is no longer welcome in India. After the border provocation, investment opportunities for China have dried up in India. Restrictions have been placed. Chinese cash is now kryptonite for Indian businessmen. Investment from China is watched, reported and scrutinized. India's ICICI Bank is the latest case. A report came out today that said that ICICI has a new investor, the People's Bank of China, the central bank of the Chinese state, the same institution that had invested in India's HDFC Limited in March. But this investment is minuscule. Here is what this is all about. Recently, ICICI Bank raised 15,000 crore rupees from the market. That's over $2 billion. This was a qualified institutional placement exercise, QIP. What is QIP? It's a way for listed companies to raise capital without submitting legal paperwork or going through regulatory approvals. Now, the People's Bank of China invested 15 crore rupees. It's loose change for them. That's little more than $2 million. So more than $2 billion was raised and China has put in 2 million of it. There were more than 300 investors who participated, so China's central bank was not the only one. According to one claim, the People's Bank of China has a stake in ICICI. Its stake is 0.0006%. That's very small. And it may not increase very much because India has put curbs on Chinese investments. China can no longer invest freely in Indian companies. In March, it's a story we told you, HDFC Limited reported that the People's Bank of China now owns a little more than 1% of its shares. It created quite a stir. There was talk of a hostile takeover because China's central bank had bought these shares from the open market. The Indian government then introduced new rules. Any investor from India's border nations, which includes China, now needs government approval for investment. China can no longer just buy shares from the market. It needs to go through a government approval process first. The Indian government took a stand against Chinese investments even before the border standoff in Ladakh began. In May, India's Finance Minister Nirmala Sitharaman gave an interview to us and she had promised more safeguards against hostile takeovers from Beijing.
We have to take care that businesses which have been built by the sweat and toil of Indians and which have had a great brand value cannot be allowed to be picked up by people who are just looking for an opportunity. So that is a factor which all of us are worried about, and that's a factor on which we'll certainly do something to ensure that Indian industries don't get picked up at a throwaway price, because we want them to be able to run their business once everything is normal back again.
India is now taking specific and targeted measures in curbing the flow of Chinese cash in the Indian economy. The Chinese companies have now been restricted from participating in public procurement bids. In the month of June, India made it mandatory for sellers on the government e-marketplace portal to clarify the country of origin of their goods. Restrictions have now been placed on color television imports from China. India is now considering measures to prevent trade partners in Southeast Asia from rerouting Chinese goods to India. Basically, anything Chinese from Southeast Asia will not be allowed in. Demanding boycotts is one thing. The need of the hour is to de-link China from the Indian economy, reduce its participation, stop the flow of cash, because for as long as the border provocations continue, it cannot be business as usual with the Chinese. And with the recent decisions of the government of India, it looks like the decoupling of Indian and Chinese economies has finally begun. Of course, we have a long way to go.